good morning, good afternoon, wherever you are. Thank you so much for joining us this afternoon. I will ask you please to keep your audio on mute while you are not speaking. But you're welcome to keep your video on if you like, so that we can see you. Feel free also to introduce yourselves in the chat so we know who you are. It'd be nice to see who's in the room. You can also comment and ask questions in the chat box. We'll be monitoring those, and at some point, our moderator will open for some discussion and also answer questions as they go along. Thank you so much for joining, everyone. First and foremost, I'd really like to thank our colleagues at Market Links and Aceli Africa for co-hosting this event. My team at SAFN, of course, always for organizing, and most especially our panelists today, Andrew Ahiaku, Phyllis Wanjiku Kimani, Evans Martin, Nakoko, and Henry Buogi. I hope I didn't butcher anyone's name, who agreed to share their insights and experiences with us today. They will introduce themselves and their organizations directly, so I won't do that now. However, I would very much like to acknowledge that they are in countries badly affected by the cyclone that struck East Africa a few days ago. So we are not only grateful that they are well and able to spend a bit of time today, but just be aware that if we experience any technical difficulties, we'll manage that as we go along. For now, everyone seems to be doing okay, so we will hope for the best. So thank you all panelists for being here today. My name is Nadia Martinez. For all those of you who don't know me, I lead the Secretariat of the Smallholder and Agri-SME Finance and Investment Network, SAFN. If you don't know SAFN, we are a network of organizations across the agri-SME investment landscape, working collectively to advance inclusive finance for agri-SMEs and reducing that persistent finance gap by addressing bottlenecks at the ecosystem level. Andrew will introduce Aceli Africa, and so I will leave that to him when I pass the mic. Today is the third and last session in our webinar series. We've called it Backing the Middle: Conversations with Practitioners. And we've been exploring the question of how investors can sustainably finance the smaller ticket sizes that are usually needed by agricultural businesses in emerging markets. We heard from fund managers in the first session and international donors in the second. Today, we're delving into the local finance marketplace with representatives from commercial financial institutions. This conversation also follows a recent panel that was held at the Aceli Africa convening in Uganda, which drew quite a lot of interest. So again, please type your comments and questions in the chat. Enjoy the conversation. And Andrew, I hand it over to you.
Thank you very much, Nadia, for having us. It is a joy to be part of the panel and moderating with my senior colleagues, Evans from Centenary Bank, Phyllis from Family Bank, and Harry from TCB Bank, Tanzania. So my name is Andrew Ahiaku. I'm the head of financial sector for Aceli Africa. And for those of you who don't know, Aceli is a data-driven, donor-funded, market-level agricultural finance initiative with focus on East and Southern Africa for now, with the potential to expand into other sub-Saharan Africa in the coming years. We are focused on agri-SME lending. So our focus is to increase lending to agricultural SMEs in our chosen markets. We got here because we did a research which suggested that lending to agri-SMEs is twice riskier than any other sector in the economy, and the returns were 4 to 5% lower than expected. And so Aceli designed products to respond to the risk and the cost of doing loans to agri-SMEs in our chosen markets. For today, our focus is to hear from our senior practitioners on what works and what does not work. And I'll leave the introduction to them as they tackle their questions one after the other. So on my screen here, Evans is the first I see, and I like to call him Senior Evans. Evans, you get opportunity to introduce yourself and your institution, while you also share with us maybe just 2 challenges that you face as an institution lending to agri-SMEs. And if you can also add if there are any policy issues impacting on your bank as you try to lend to agri-SMEs.
Okay, thank you, Andrew. My name is Evans Martin Nakoko, as you rightly said. I am from Centenary Bank, Uganda, a subsidiary of the Center Group. And I bring you amiable greetings from the MD and the team from Centenary Bank that you probably will be able to see on call. You asked me to share some challenges. I will just focus on 2. For us, it is the high lending costs, especially to enterprises that are tenable in the informal value chains. And we know that these are associated with high risk profiles. And so this comes with high costs in order for us to maintain the latest digital transformation, because we are trying to leverage on digital options and keeping abreast with the latest changes. And given the costs that we keep talking about, this is a critical challenge for us. And then, of course, the high cost of capital. And this is both capital that is mobilized from wholesale lenders, which would come at a cost, and maintenance of the local deposits to support our lending operations within the confines of regulation. And of course, if we are getting the money elsewhere, if it's out of the country, we have to deal with the exchange rate risk. And also we have funding maturity to manage as the critical probably challenges that we have to usually battle. You also requested me to mention some policy issues that we probably are battling with. One of them has to do with the changes in the international financial reporting standards. And for purposes of this discussion, I'll focus on the IFRS 9. Now, the IFRS 9 meant that institutions were moving from the incurred model to the forward-looking requirements. Of course, forward-looking requirements implies that we'll have to do projections and take care of risk before we even lend. This is, of course, challenging, and it calls for a high degree of subjective judgment. Now, in trying to understand this, there are about 3 issues that I will quickly mention. One is credit losses. Now, reported credit losses are volatile in this case. They have increased, and we also expect that they could increase across countries. And this is because of these changes. Then the number and complexity of judgment is also expected to increase. A lot of it is seemingly subjective. What this means is if there is subjectivity with the perception that lending to agriculture is risky, it would mean that financial institutions may want to choose other sectors other than agriculture. And of course, the perception that agriculture lending is risky may jeopardize the consolidation of portfolio growth that we've garnered over the last decade. Let's also look at it in terms of classification and measurement. Classification of assets is also becoming more judgmental, and it may affect how capital resources or requirements are calculated. Even when we are allotting resources for various sectors, if your sector is seen as risky, then the resources may not come your side. And finally, on this point of reporting, there is the requirement for disclosure. Now, extensive new disclosures are required, but these require you to have system control changes that will definitely capture the required data. These all talk to the issue of costs. The second critical issue about policy is about the capital adequacy ratio. Basically, financial institutions use CAR, or capital adequacy ratio, to measure how much a bank has available to itself. And it is the percentage of the bank's risk-weighted credit exposures. According to Basel II, this is established at 8% and 10.5% for Basel III. The purpose is to make sure that banks have enough capital on reserve to be able to handle certain amount of losses before being seen as becoming insolvent. Therefore, lending to risky sectors requires a commensurate capital adequacy to demonstrate that the money that the depositors keep with us is safe. A low capital adequacy ratio does not only stifle the bank's growth intentions, especially in sectors like agri, but it also implies that banks may resort to selective lending or even no lending at all. Now, if a choice were to be made between sectors that will probably miss out on credit, many people would start by reducing supply of finance to agricultural finance. Thank you, Andrew.
Thank you very much, Evans, for kicking us off with those interesting observations. Maybe I'll turn now to Phyllis. While you introduce yourself and your institution, are you able to share with us what your percentage of agri was in 2021? I mean, the size of your agri book and now, and then also share with us, as you've grown, what have you identified as the ingredients of success in assisting you come to the level that you are now, especially winning the best bank in the Aceli network last year?
Thank you, Andrew, and good afternoon to everybody. My name is Phyllis Kimani. I'm the Chief Retail Banking Officer with Family Bank, a local bank based in Kenya with 95 branches. We just opened our 95th just like 2 months ago. And I would say it's a local bank, locally owned, and we are founded, in fact, Family Bank was founded through agriculture, mainly by lending what we call the tea loans. That is to the tea or the smallholder farmers that deal with tea. To the question from Andrew, there's what we call pre-Aceli back in 2021, when we started getting into partnership with Aceli. And when it started, we had an agricultural loan book of 2.5 billion. And out of that book, 92% was tea. That comprises around 2.3 billion. And overall, out of the whole loan book of the bank then, 4% of the book is what was being contributed by agri. Out of that, I would want to have a conversation with Aceli on how we are going to drive it. Then the conversation was, you're not going to incentivize you to doing what you do best. That is anything related to tea. And for a better view, we'd say, by then we separated the book to what we call tea and non-tea, because you see, we founded on tea and we are doing very well in tea. And as I had said then, only 8% of the book was what we'd call the non-tea. And this prompted a change of strategy in lending with a focus to maybe other value chain through the diversification agenda. How are we looking now in 2024? Our agricultural loan book has doubled to above 5 billion as we speak for the last, it's around 3 years. And what we'd call the tea loan, which was 92% then, currently standing at 28.5% of the total book, meaning it's only almost 1.4 billion. And I would say overall, out of the whole loan book of the bank, remember, pre-Aceli we had 4%. Currently, we are contributing 5.5% of the whole book within the bank. And when you look at how the book have moved, it has been evidenced that our diversification agenda worked by removing our concentration, because we are highly concentrated within the tea sector with 92%. And I would say this is one of the strategies that was catalyzed of diversification by Aceli through the incentives that they have been able to give us through what we would call the non-T loans, because we are never incentivized for giving any T facility. We had a very deep conversation with Andrew then. Why not? And said, you do it very well. Then why do you want to be incentivized for doing what you do well? And I would say then, what has been what we'd call our ingredient of success for us to be where we are today? And I will start saying deliberate steps had to be taken. And as Family Bank, we took very deliberate steps to ensure that access to finance within the agri actors is realized. And some of the measures that we had to put, and also identified other value chains outside T, because yes, we had perfected T, because within the country is one of the structured, I would say one of the structured value chain within the country. And that means we had to go now to the non-informal sectors or non-informal value chains within the country. And one of the key measures that we took, number one, is we came up with what we call an agriculture strategy. Now we have a strategy that is basically driving agri, and it is plugging into our bank strategic plan. Again, we also came up with a dedicated agriculture team, both at head office, where we had a head of agriculture, and with a number of RMs that are driving that agenda, and also within the teams in our branches. Again, we also sat down and looked at which are these agriculture-specific products and services that we can be able to offer our customers. So we revamped our customer value proposition with a different offering that touches to the specific value chains that we really wanted to venture in. And we came up with those specific products and services that we needed to offer. But you cannot succeed until you're finally aligned with all the teams within the bank. So we had our own internal alignment, starting all the way from the MD, the executive of the bank, and I sit within the executive of the bank. We had our finance team coming up. We had our credit department, the risk department, and also our branch team. And what we did using the incentives that we had, we did a lot of training and capacity building. And majority of the products that we offer within the incentive we have a central credit analyst team where all branches send their facilities to. We took that team and took them a thorough training so that all of us are aligned and we are able to understand what is it that you're looking forward for. Then we had a team in branches, and we didn't train only what we call the salespeople or the agriculture team that was driving agri. We trained all teams, whether they are front office, they are back office, they are tellers, for us to get a better understanding that what is it that you're talking about and what is it that you want to deliver. So we got those formations by having a strategy. We had an agri team. We have specific product and internal alignment that we align day in, day out. So it's not that we stopped aligning. Even now, we are continuing to align because you remember also lending is dynamic and it changes depending on how different value chains place themselves. Thank you, Andrew.
Thank you, Phyllis, for taking us through your journey, where you were, where you are now, and some of the things that have pushed you or things that you identified as the ingredients of success that have brought you this far. We will come back to those again shortly. Senior Henry, at TCB, you are noted to have started from a very low base and doing wonders now. Did you face any challenge in doing so? And what advice would you give to a lender who is very early on the agri-finance journey?
Yeah, thank you, Andrew and the team. As you said, my name is Henry Bogi. I am a director of retail and business banking at TCB. TCB is a commercial bank, and we have 82 branches as we're speaking now around the country. And my department is one with dealing with the agri. And greetings from my CEO, Adam Mihayo, and my colleague Lucius Nelson and Gloria. I think they are watching us. Now coming to the challenges you say. Of course, if you look at the challenge we have, there is the policy challenging in lending, as you say. And if you look at this, very interesting, I think this looks like a regional challenge. I was hearing Evans, what he has been narrated almost with us. So we have some policy issues even for us, which are impacting agri-to-agri lending in our country and into my bank also. Yeah, he has talked about the capital adequacy ratio. Of course, even for us, this is one of the challenges. As you know, agriculture involves high cost of operation, for sure. And there's a limited fund to allocate to the agriculture due to its risk profile. Most of the banks are taking that. So lenders tend to see agri as a risk and the cost to handle their portfolio. So apart from the cost of funding, it can also involve follow-up, monitoring costs at all stages of agriculture cycles, from planting to harvesting, stocking, and up to the selling. And most of the agriculture process is being taken in a remote area, as you know, out of the urban or out of the town centers. So transportation and the other communication costs, of course, it is relatively hard. So when you're looking at the capital adequacy ratio now, you can see one of the policy issues which are hindering that. But again, we look at the loan loss provisioning and classification, as my colleague said. We normally applied both central bank and the IFRS 9, as we say, the criterion per the commercial banking standards, which considering risk associated with this agriculture. So a few countries in the world I know applies classification criteria as per DFIs, this Development Financial Institution Standards. But if for the commercial bank, you apply the commercial bank IFRS 9, of course, NPL will be high. Why? Because the central bank and even IFRS 9 pegged on buckets and number of days in the classifications, 61, 91 days, and so forth. But if you look at the nature of the agriculture, this is based on seasonality from the harvesting. So whenever there is a challenge on harvest, automatically the loan loss provision will hit you, burden your numbers on the spot. Because of the provisioning now based on number of days, now you are talking about 60, 90 days, and so forth. Unlike from the normal short-term loans. So, and this, from any lender, we see that the agriculture is not a friendly. But we have another thing on the central bank, sectorial or industrial classification. How do we see this agri in our portfolio? Sectorial classification by the banks and the financial institutions in Tanzania are in accordance with the bank setup or the central bank setup. So in agri-financing, in most of the time, Andrew and the team, it renders it difficult to segregate or to classify the sector in one, say, farming and the aggregators. Most of the aggregators are being classified as a trading or transportation or stockist sector rather than agribusiness, you see? Yeah, for example, a farmer who is setting up his land for agri can be qualified to be classified as the agribusiness. That is right away. But if you are to buy, let's say, a tractor or any farm implements, this will be classified as the asset financing, not agribusiness, okay? If you are to set up a godown or warehouses for stocking your harvest, the sector to be classified shall be warehouses and packaging, not agriculture. So in case, if you need to set a machine for processing your products in order to add value before you sell it, that one will be termed as a manufacturing or processing, not agriculture. If you want to acquire a truck for transporting your produce from your warehouses, again, to bankers, this will be either classified as a transportation or asset financing, not agriculture from the beginning. So if you are engaged in transporting your product now from the warehouses, distribution center to the final consumer, your classification may be either marketing or transportation again. Now you can see the problem. Agriculture is put away. So in most of the time, and in accordance with reporting standard, banks are not recognizing aggregation operation as part of the parcel of the agriculture. So other banks, like what we did for us, you have to have a primary reporting and then secondary reporting in order to put your agri-business maybe in a real picture of what you are doing. So the other aspect I can share is on collateral requirements for banks. For the case of our country, most of the portfolio in agri-SMEs clients are only traditional collateral. So they depend on guarantee from, let's say, PASS or Tanzania Agricultural Bank for that matter, and the other funders. Without guarantee, very few agri could qualify for that. So most of the farmers lack adequate collateral, especially traditional ones, which are registered documents to include the title deeds. Not only that, but also a team, since most of them are in villages or in remote areas, those farmers, when they are subject to expert evaluation, their value also are relatively low, the valuation of their collaterals in comparison with those urban centers, because of the system. So you can see now that in SMEs, we have a challenge of the collateral requirements.
So Henry, thank you very much for those interesting observations, and we'll come to them so you can share more insights. Maybe let me get back to Evans. So yeah, you shared with us some of the teething challenges. Henry has also mentioned a couple of them. Will you say a bank like yours needs an incentive, including guarantees and first loss covers, to lend? If you think you do, what type of incentives and at what level will you need them to be able to increase lending to agricultural SMEs?
Thank you, Andrew. And yes, and I will gladly explain this affirmative choice of response. I want to just highlight 3 priorities that, and I'll be able to justify. The first is the origination incentive. The second I'll talk about is the loss guarantee. The third interesting one is around technical assistance and the market trends that you faithfully share with us. The origination incentive is critical for us, and the essence of this origination incentive is to compensate for the high cost of extending credit and the low revenues that could arise from those challenges we get when we have weather vagaries. So if we are able to get this compensation, our zeal, our enthusiasm to lend more than triples. What does this imply to us as an institution? That as a financial institution, we can revise the appetite for lending to high-risk sectors such as agri. Of course, we can debate whether it is risky or not. That's for another day. But many will presume it to be risky, and they will associate it with posting less revenue because of those unforeseen circumstances. Yet, where I see it, we are part of the largest contributors to the income of the institution. The second implication that we have for this original incentive is the change in perception by the strategy team and the budgeting teams, because then we assure them that we can still make money even when we have not been able to wait for the outcome of the lending decision we've made. It means we can debate better for resources. The second reason why we would want to emphasize origination is that it is a vehicle for us to expand on our horizons into the less privileged but seemingly risky clients. Our institution is here to serve the ordinary Ugandan. And even when we go through vehicles that are corporate in nature, such as anchor bodies under value chains, we still have a spotlight on the smallholder and the ordinary Ugandan. So SMEs for us provide market, and when we finance them, they link back to our smallholders. Now, if you are able to help us expand our horizons, the implications that play or underpin this thought, there are about 4 of these. So you enable us to increase portfolio specifically under the youth, under women, the green loans we do, and you help us to adhere to our ESG framework, the environmental, social, and governance. You've helped us to anchor our value chain strategy that has both formal and informal chains. Now, the informal value chains become tenable when we have such an incentive. This incentive also underpins the acquisition and retention strategy for the growth of our portfolio. We can get new clients because we know there is a special incentive for new clients coming in, and we can also contribute to the formulation of customer value propositions that speak to the requirements of our customers. It is at the deepest of our points in that it's in our hearts. It is deeply enshrined in our hearts, because then we can be able to deliver the mission of the bank. The second is the loss guarantee. What the loss guarantee does to us is it spurs the lending appetite for the bank, while at the same time cushioning the bank from losses that could arise from the credit risk. We can manage NPAs in a more bearable way, we can manage our provisioning, and we can be more profitable. Behind this thought that I've just shared are interesting components that happen. Behind the scenes, we have internal risk infrastructure reorienting from a risk-averse kind of environment to a proactive risk management approach, so that people are not looking at what does not work in the case you're booking, but how we can make the cases work for the institution. There's confidence to lend. And when people are confident, they can make decisions for various levels of credit at the branch, at the head office, and wherever this decision sits. Again, this loss guarantee is a pillar that will again shape our value propositions, because to our customer, we will say to them that we can be able to lend you with less collateral margins than the ordinary customer who is not under such a scheme. Finally, technical assistance and those market trends you share in those reports are supporting us a lot on the issue of our digitization journey and how we handle our capacity building for both staff and clients. For us, what this delivers is seamless and responsive offerings to our clients. And the more relevant we are to the requirements of our customers, the more we win each day. And that is why we are now the second biggest bank in our country. At the end of the day, all these incentives are currently touching 30% of our loan portfolio, and they assure us over 12% growth, even when we have payoffs for production loans. Thank you, Andrew.
Thank you, Evans. So you shared with us why you need incentives and what it does for you as a lender. Maybe let me hear from Phyllis. Phyllis, you alluded to some of the incentives pushing you to diversify your T-book and moving into other value chains that you would otherwise not have moved to, including other things that you have done. Will you say that incentives encourages a lender to do more, and does the incentive have the potential of changing an investor behavior in the long term? Or maybe to put it in a better way, assuming there was no incentive 4, 5 years, 10 years down the line, will you still be actively lending, driving lending like you are doing now when you have incentives?
Thank you so much, Andrew, and thank you for the question. And allow me to say this. A lot has happened since the time started the diversification. And by using the incentives that we have in many ways, including passing them to our customers, especially when it comes to reducing their processing fees and the rest. Going to your question, should we continue lending to agri-SME in the absence of Aceli? And I would say, we are aware Aceli will not be here with us forever, but we just hope and pray it can remain for longer. However, when you look at the agri-SME market within the country, it's still very young and not yet mature. And it requires a lot of support. If you look at the way the agri is sitting within our country, it's very young and requires a lot of support. And I would say that the support that Aceli is currently offering, it's very important for us because it is helping us to move the sector to maturity, which I know it might take a bit of time. But looking further, we can look through the technical assistance as one of the components within the Aceli program that plays a very big role because of sustainability beyond the life of Aceli. And that is where we are looking at what within that program, what is it that we can be able to pick that can become part of the areas or part of the places whereby we can ensure there is sustainability beyond the life of Aceli. And I would say we have gotten learnings and we have ventured into some of the value chains that they are, and Evans put it very, very well. But issues to do with agri, whether it is risky or not risky, is a bigger discussion. And I would say, yes, we've ventured into some of the value chains that are also quite risky, if I may put it, because they are not in what we'd call a structured way, or they have not been structured like some of the value chains within the country. And by lending into that particular, we also have picked key learning. So I would say, even with Aceli and the handholding they are giving us right now, they have made us to venture into some of the value chains and also get a bit of understanding. But my final comment would be, we have our learnings, we are really moving. Our sector is still very young, and we still need a lot of handholding until our sector gets into the maturity within the country. As we also see that how do even our own government also come in to help support the state sector. Thank you.
Thank you, Phyllis. Incentives are important. They are critical. They are helping you to change behavior. But you think that the incentives will be required a little more while before maybe they go off completely. And I must add that even in the developed economies, they still have incentives in one form or the other. So we hope that going forward, we'll get more support to be able to offer and do more than we are doing now. Now, Senior Henry, you have an interesting story. You started from, again, a very low base. 2% of your book was in agri at the time. Now you have moved, and as a result of the incentives, the story is told that your RMs are able to move about 400 kilometers to visit clients, support women groups, and learn for the first time to people in the cassava value chain. Share with us what happened, what motivated you, and how you are driving that.
Yeah, thank you, Andrew. As you put it clear, 3 years ago, before we joined Aceli, our loan book was almost 1.9% of the total portfolio. And now we are talking about 4+% of the total portfolio, of which in agriculture in the country, we are rated one of the most growth. Our growth are most of the growth growing that loan book in the country compared to other banks. Of course, you can take in terms of the quantum, whatever, but there we are. Now, coming down into the example of the cassava, of course, for those who are not aware, we started cassava 2 years back in Kibondo. Kibondo is situated in that western party of Tanzania, neighboring with part of Burundi and part of Rwanda. And the Kibondo is a district from the Kigoma region. So you can see how far the area is, but it is potential in growing cassava. And the species which has grown there is well recommended in our region. So, as said, when we started, as we said, we were shying away to go to such kind of areas because of the distance. Of course, roads are not tarmac at all at that time. Sometimes it is raining, like what is going on here in our country. And you can go with the vehicle coming almost with half of the vehicle. A lot of, you have to go to the garage the moment you're turning into town. But Aceli came as a hero, I was a hero. You gave us a courageous to go there. Yeah, we were able, we started, of course, in year one with 9 customers and be able to lend about 1.9 billion during that season. A good thing that all the facility was cleared even before the maturity date of that time. And then when we came now to the second year of this operation at Kibondo, of course, we looked at it, expanding our portfolio from 9 to 30 aggregators with loan value of 3.9 million USD. And to include the product of other value chain of about 588 million, including farmers, aggregation, and so forth. And the aggregation were able to expand their warehouses within the second year of operation. Brilliant one, modern warehouses, okay? Of which at the end of the day, that can be taken as a collateral, something like that. But we increase the purchase capacity from the smallholders, farmers, and many of them, they are women and youths, if you go there. So as a bank, and then we sat and decided how to go about it. A good move, what we made, because we have an incentive from that particular area, and then we have a first loss cover, we lowered our prices. At that, the year one, the pricing was ranging between 14% for the facility. As we are talking now, we lowered up to 9%. That was the good news for those farmers, youth, and the women, along with that. Okay? And that's why, because of the compensation of that one. And then we are going there, apart from the transportation and fossil, we are talking about the telephone, follow-up cost is something that, of which somewhere something has been compensated. But as my colleague said, you have this origination incentive, which also are being now used to reinvest and then making the cost of fund for that product coming lower. If by the case, why can't you lower the pricing? But that was the good news to our people, to the farmers, and then we are there. And it is taken as an example across the country, but to my portfolio within the bank, of course, things were able. Maybe I can't say something about the bonus and whatever, but there where we are.
No, thank you very much, Evans, Henry, and Phyllis. Yeah. My village people used to say, when the dance gets interesting, you should remember that you have a long journey to walk back to your village. So we are not alone here. We need to take some questions from the audience. So we'll turn to the audience shortly. But before we turn to the audience, quickly, maybe to Phyllis first. Aside incentives and the policy issues that have been mentioned, will you say there are other challenges impacting lending to agri-SMEs? Yes, briefly, maybe 2 will do. Then we also hear from Ivan briefly before we turn to the audience.
Yes, thank you, Andrew, for the question. And I would say, yes, there are also other challenges aside from the incentives. And one, I would say, I don't know whether to call it, I would call it financial literacy, or it's more a bit of education, which affects mostly in terms of planning, cash flow management, deploying the capital for business growth. And we also tend to see the same aggressive, using the short-term credit to finance the long-term needs, and also a bit of bookkeeping, which becomes a challenge as a financier when you are looking forward to finance that particular customer. The other bit is the high cost of doing business, or the high cost of doing their business in the agribusiness. And you will find most of the agri SMEs don't leverage on technology to improve on the efficiency, either because of affordability or capacity constraint. And this leads to very thin margins, which in one way or the other becomes a turnoff to you as a lender. Because once you look at the margins that are coming from that particular business, then you find they're also quite thin. And finally, you will find also within the same businesses, especially when it comes to the primary production, they lack what we'd call a business continuity plan, and which we all say is essential when it comes to lenders for business survival, beyond who we would call the key person. So you find once the key person is not there, then that particular business also tends to come down. And aside with the incentives, it helps us cover issues to do with corruption and the rest. But those are some of the other challenges that you'll find you're facing to be able to support this particular. But a lot of education comes in to be able to sort out some of these challenges that you're facing. Thank you, Andrew.
Felix. Evans?
Once again, thank you, Andrew. Besides the high lending costs I mentioned earlier and high cost of capital, there is what I refer to as the syndicate and politics of value chains. You want to push for involvement of all using the value chain approach, but you have anchors who are generally business people, and they respect the neoclassical economist theory of price and demand. And so if you support the value chain to produce more, they want to offer a lower price because there is plenty, and vice versa. So the efforts that are made towards ensuring that you have value chains that work, in making sure that the anchor is actually, all that effort kind of goes to waste when things flip. But then also, talking about financial institutions, it would be difficult to conclude this discussion without mentioning fraud, whether it's going to be cyber supported or the normal. I think realistically, fraud is something that is internationally known as a huge challenge. I would probably hasten to add these two to the first two. Thank you.
Thank you, Evans. So we'll now turn to the Q&A, and the questions are coming in thick and fast. Some are directed to particular panelists, while others are open. My good friend Anthony Mbiti says, policy and regulatory environment appears to be a big elephant in the room. Any efforts to address these across the markets? Any best practice out there? That is coming from Anthony. Are there any best practices to tackle regulatory challenges out there? My dear panelists, do you have any idea of best practices to tackle regulatory and policy challenges out there?
Sure, Andrew. I don't know whether you would permit that I just make a small contribution here.
Okay.
Yeah. I think one of the things that we realize is when you now begin to pursue partnerships that have the public the public and the private sector, usually when you have more people supporting you on advocacy, you can be able to win some of the battles in this war. Otherwise, the next thing you have to do is to innovate, to be able to manage the calls of such a regulatory environment or a policy environment. Thank you.
Thank you. Maybe while we have that, there is a question, and David, I've seen your hand, so I'll give you the opportunity shortly. But there's a question directed to Evans. Have you sort of interacted or come across other guarantees? For example, USAID, CEDA, etc. How have they performed? And if you had a magic wand, what would be your suggestion on what to do to make things better?
Well, thank you, Andrew. Indeed, I have, and we have as an institution interacted with several other guarantees. The usual ones that we all come across are paper guarantees that have a risk-sharing component, a 50-50, for example, and where you have a vulnerable sets of people you want to include, maybe 60 or 70%. The magic here is what you negotiate for. You cannot get what you don't negotiate for. One of the challenges I realize with some of the financial institutions would be that we are recipients of everything that seems to be thrown at us. You would want to look back at your strategy, what you are out to achieve as an institution, and then look at like-minded partners. That way you can. Otherwise, in the past, we've worked with USAID, but usually those are not revolving guarantees. So you work with them for a short time and move on. You achieve something and move on. But we also now have the ABI guarantee that is revolving, and we've done this, I think, for over 15 years. And for them, it's revolving. So the uniqueness there is that you utilize, review it after 3 years, increase limits where possible. Yes, but then the difference between those guarantees and what we get from Aceli is, for example, for the first loss guarantee, I have the freedom of choice. I have those degrees of freedom to choose what kind of loans or non-performing loans I apply to the guarantee. Elsewhere, it will have to be that specific client who you placed under the guarantee. The degrees of freedom will help you actually manage your NPA at a time. For example, if you're closing your financial year, you know which cases to deal with, as opposed to a situation where you will remove a case that will not impact on how your quality will look like or your provisions will look like. That's what I would contribute. Thank you.
Okay, there is an interesting question in the chat, and I'll direct that to Henry. Banks, especially commercial banks, have been accused of lending to secondary agriculture in the name of doing ag. And I know this is catching you on the spot. Of the nearly 5 billion that you are doing in agri now, what percentage will you say is into primary production? And do you have any some value chains off the top of your head that you can recall that money is going to?
Yeah. Thank you, Andrew. For us, for the case of, let's say, Kibondo, as we are citing, when we are talking about that, of course, we have some aggregators, but what do you financing in the first of the time? They are the direct to the farmers, okay? But of course, apart from that one, in Kibondo, in the Tanzania Commercial Bank, we have some product like micro lending or group lending that are directly impacting those on the ground rather than the aggregators. Yeah. And as we are talking now, for the group lending, which is particularly for the women and youth, our portfolio ranging up to 6 billion as we are speaking. Now you divide by 225. But if you look at the micro lending, our portfolio now stand at 45 billion Tanzanian shillings. What does this mean? Most of them, we look at it, 60% women, 25 youths. And these are going to the direct of those people on the ground, rather than coming to the primary producers, something like that. Because we have graded according to the need. The small one, middle, SMEs, and then part of this. So yes, we have structured in such a way that there is a big portion which is going to the root, down to the root, to the farmers themselves, to the startup, and so forth.
Thank you very much, Henry. Sadly, we are out of time and we have tons of questions, but I need to turn back to our host, Nadia Martinez, to give her the chance to give us her final words and parting remarks.
Thanks so much, Andrew. And I'm sorry we haven't gotten to all the questions, but we do have them here, and we will try to address the ones that were for specific people, that were addressed to specific people. We will send them to them so that we can try to get answers and post them when we post the recording. So as Andrew reminded us, there certainly is a journey back to the village and lots still to be done to expand these types of incentives and support to increase financing to agri-SMEs across the African continent and beyond. But let's acknowledge at least the progress that's been made so far, especially these last few years under such extreme circumstances. And you've heard some of these very inspiring stories. I invite you to learn more by reading Aceli Africa's recent benchmarking and learning reports, which you can find on their website. And also make sure to visit sapinnetwork.org, of course, for other efforts across the agri-SME finance ecosystem. Since this is the last of the 3 sessions that we planned with Market Links and other partners, I would like to invite Songbei Lee, though, who is joining us today, to just say a couple of closing remarks. And thank you all for joining. Songbei?
Thank you. So first of all, I want to say thank you to Nadia from Sapin. It was her idea to create this series, and it's been great working with her. I'm also thankful for Andrew and all his guests, the Aceli Bank partners. It was great to see this panel in person in Uganda, and I'm really happy that we can share it now with a wider audience. And I know this will be recorded, so those who couldn't make it will be watching this recording in the future. So thanks again, everyone, for joining.
Thank you to the panelists. Thank you, Andrew. Brilliant job. Bye, everyone.
Bye. Thank you too.
Yeah, I appreciate it. Thanks.